Hey guys, welcome to this video. Don't forget to like, share, comment and subscribe and grab my free training underneath. In this one, we're going to cover the US dollar against the Canadian dollar. It's something my members, my students around the world have asked me about this a lot. It's one of the FX pairs I think a lot of traders really focus on. And with good reason. For the last, let's say, if we flick on a monthly, since 2016, you really haven't deviated much from up here to along here. Now, I'm going to make this analysis fairly long term because obviously people are going to be watching it at all different times. You might be viewing this 6 months from when I film it. But that long-term market has provided so much for traders because you had your big rejection here, okay, clear price action level, people pulled their orders out. In other words, the price came up from this point, okay, within this sideways trajectory. It came all the way up here, and the reason why there's a thin line printed where I've drawn this arrow is because that denotes where price went before it fell back away within that same month. Now, that's really significant because what that tells us is traders and investors alike said, okay, well, the price has reached more or less around 143 and onwards to 146, okay? And for that reason, we're going to say, right, that's a more than valid price for us to exit those entries. And of course, that's what they did. And that's why you get such a big pull down, because people decide that that price is too high for them. And of course, they then take their orders out in the market. People start to short. Okay, naturally, if you're taking a long position out in the market, you're getting short. And you can therefore see that the price falls down. So the weight of all those orders being exited pulled the price all the way back down, at which point you can see it rebound to the upside. Okay, so that coincides with your stock oscillator, tells you the price is overbought, and then of course once it falls, okay, it becomes oversold. Now, it's really important that the first time this happens, you take very large significance of it, okay? Because once you return to this level or this area, to the long side first, not to the short side, you can see that what happens is another rebound. So instead of people exiting their longs, this time they take longs or they exit their shorts. And what that does is, again, is it causes a rebound in the market. As people begin to exit those short positions, they start to get long and the market moves up naturally. Now, the reason why this happens, coordinated with a sideways movement or sideways trend, a choppy market, for a significant period of time, I mean, you could really say this started in 2015 and we're now in 2023. So 8 years of movement between, on average, 124 and 142 area. The reason why it's significant to note that is because once you come back up here, you have to just stop and you have to think to yourself. Now, this is why I teach people to trade. I really enjoy trading because it's all about solving the puzzle. And, I had some fantastic mentors who taught me very well that all you need to do really is look at charts, look what's happened before, and make a decision based on that, because that's the only way you can get factual probability. Okay, factual probability comes from what you can visually see, because what you can visually see is not a debated topic. Okay, there's only one reason why the price would pull away from an area. It is simply because people exit longs, okay, and they get short. There's no more to it than that. It's not a magic trick. It's not a party trick. It doesn't happen by accident. It just so happens that when people take those orders out, that level of price action becomes important for the next time. And that is what professional traders, institutional traders, the larger money in the market, the people who are making money in the markets do, okay, because they're reflecting on what is a preferred high price, okay, because that is what a market is. It's a movement from low prices to high prices. It does not matter whether it's the dollar CAD or it's the Mercedes garage down the road, okay, if you live near one. Maybe you don't, maybe it's a Lexus, whatever, Skoda. I'm not too keen on those cars, but the Mercedes I do have. So anyway, the point is markets are just like that. If someone's trying to sell a car, ideally they're going to do it at the highest price possible. Now, it just so happens that these levels also coincided with this over here all the way back at the start of the millennium. Okay, and again, that's no surprise because they're just using this rejection here as a means for new rejection there. So the long-term market, essentially what I'm saying is it's long down here near a 123, 124 area, as you've seen various times, and as you'll probably continue to see. Okay, that provides your long side bias long term, and it's short to the upside. Okay, as you get to the upside. Now, it's important to note that you're not always going to get up here straight away. Although I do expect that in the future, sometimes price will stop before it gets there. And that's absolutely okay, because your job as a trader, like I said, is to look where price has rebounded before and perhaps decide to take an entry. Of course, if you've done that recently at these local levels I'm highlighting now, you would have had profit because it fell straight back to your MAs. And again, to the long side, this is where you've seen rejection. So you may decide, instead of waiting for it to get all the way back down here, I'll take it long at these early local levels here, or just as we happen to rest on key MAs. So it begs the question, nearer term and longer term, where would you like to short this? Well, you can already see coming to these local levels, like I said, that had provided price rejection in the past. You can see it similarly there. I've just drawn that. I'm going to take another line there. Okay, so around this level, you can see it where I've drawn this arrow here. You can see it where I've drawn that arrow there. You can see there's been various levels of previous rejection. And in fact, what you can actually see at the moment is rejection now. You can see how this candle for this month of October 2023, it's almost Halloween. Okay, hopefully the market won't get too scary. Sometimes that is okay. But anyhow, you can see around 136, 137, it's causing early reaction already to the downside. You can see people are pulling off those orders, they're entering their shorts, and hence you're getting a stalling market / falling market. Okay, you can see that right ahead and right now on my screen where I'm labeling it. So in the near term, I wouldn't be shocked if you do come down nearer to here, okay, in line with where you've previously seen people take those short orders out of the market near term. Okay, so that would be somewhere along, and I'll just draw it now, that would be somewhere along here, and that would come on a fall from that candle at the top of the arrow. Okay, it would have to come back and it would have to be a sideways movement. I wouldn't be entirely shocked if that occurs, and then eventually you get back here, you break this line, and then you continue up to the upside. Okay, so I make those arrows blue. Eventually, I wouldn't be shocked if you get to that point. If you break up there straight away, it also wouldn't shock me because today you've got important retail sales data, which are going to help a lot in the assumption of the validity or success of the global economy as it recovers. You've just had the Fed, of course, say they don't think they're going to need to do any more rates, which does give you a little bit of optimism in some regard via the US news. That could bring the dollar down still, not straight up. But I expect longer term, you'll consistently move within this range. And of course, because you're returning to key levels of resistance higher up where I've drawn, or key price action levels where you've seen that previous price rejection, I wouldn't be shocked entirely if it becomes that you fall down. Now, if you end up going straight down to here, again, my bias would be to the long side, because all I'm doing is I'm taking the last 8 years of data and I'm using that data to make a naturally informed assumption. In other words, what can I see on the screen now that would lead me to make a beneficial decision? What about what I can see would lead me to be informed on potential future price movement? Because all I can do is make an assumption based on this. It's no good waiting near the retail sales data later and saying, you know what, I think because the retail sales is going to do this, because the retail sales is going to do that, because this, that, and the other, and then making a judgment based on that, because it's not going to help. That is all fictional. That's all what I think. And because I'm not a certified economist, I could be an armchair one, perhaps. Market sentiment is something I teach. It's not too hard to filter through what's going on. But there's no good making that irrational, made-up response. Just make sure it's logical. Make sure it's logical, factual, and it's based on exactly what has played out before, i.e. price action levels, what you would rather do in the future and mix in some key risk management with that. Thanks for watching, guys. As always, I hope that helps. Follow, like, share, subscribe, ask me something in the comments, and of course, get my free training underneath. I'll see you in the next one.